All right, we'll move to the right side of the equation and the right side of the balance sheet. These are liabilities and equity. And we say, okay, you have all those assets, but how do you get it? How do you pay for it? The answer is you either borrowed it or you got it from using owner's money. So when we borrow it, we had, oh, you may recall that the total asset value from an earlier slide was 290,000. These are in millions, so that's $290 billion of assets, which must equal, because it's an equation, the liabilities and equity of 290 billion. All right, so first is, of that, we have 171 billion in liabilities and 119 billion in equity. Of that, we have current liabilities of 80 and non-current of 90. So again, we have a big number of liabilities. We break it into a subtotal, current and non, and then within the subtotal, we have line items. So within the 80 billion, we have these amounts of payables. And guess what? 1 year, right? So if it's a liability due in 1 year or less, it's current. If it's more than a year, it's non-current. Within the current, the most current, that's due soonest, is the first. So accounts payable goes first, then accrued liabilities. Accounts payable are monies that your vendors let you have on credit. So let's say you're Apple and you need some screens and you buy the screens from Samsung. Well, now you owe Samsung money for those screens, for the phones. So those would show up in accounts payable. Those are amounts that is payable, is owed by the company to somebody else. So think of it, you're the company, and a receivable is an asset, something that somebody will pay you, so it has value to you as an asset. A payable to you is something you owe to somebody else. So an accounts payable is a liability. So anything with the word payable is a liability that you as a company owe to somebody else. So we have total liabilities, current liabilities, sorted in order of how fast you have to pay. Then we have long-term liabilities, which is more than a year. And this would include things like a long-term loan payable or a long-term portion of bonds payable, or it could be pension liabilities, things like that would have longer than 1 year timeframes. Then on the owner side, the investment side, we have contributed capital, common stock, retained earnings, and other. For now, we'll focus on the first two, not the other. And it totals the same 119. So when we borrow, we have accounts payable, which are money owed to suppliers, right? That's the key there. And then when we have accrued liabilities that are obligations, but are incurred but not paid. So this is a little bit tricky, but examples would help, like wages. You have people that work for you and you owe them money, but you haven't paid them. That's an accrued liability. There's no uncertainty about what you owe or if you owe. It's just that the invoice, your employees don't give you an invoice for their salary. You know it, you pay it. The other is interest. The bank has a loan agreement with you. You owe a certain amount of interest, and they may or may not send you a bill every month for the interest. You may accrue it. So that's what an accrued is. It's monies you know that you owe, like income taxes. The government doesn't tell you how much you owe in taxes. You self-report your income and you self-determine your income taxes. So that's why these are accrued liabilities, not accounts payable. Unearned revenue sounds like a weird thing. It's unearned and it's revenue. What is that? Think of it as something you got paid before you did the work. So a perfect example is if you are Microsoft and some corporation bought a 3-year license for software and they gave you $3 million. Well, if they gave you $3 million today, did you earn all the $3 million? No, because the company can use it over 3 years. So similar to our example of prepaid, unearned revenue is revenue got in advance, and over time you're going to recognize it and take it from being a liability to being part of revenue. So after 1 year, you've earned $1 million from that license. So then you can count $1 million in revenue. Cannot count 3 million because that 3 million is into the future. So that's what unearned revenue is. It's into the future, monies that you'll earn eventually. And at that time, it'll go into your revenues on your income statement. And then we have short-term notes payable. So there's a mouthful. Short-term, less than a year. Notes payable is a loan, right? That's what it is. The term note here means that it's a promissory note, which is a document that evidences that there's a loan. So a note payable is simply a loan. And then we have current maturities of long-term debt. So again, even more of a mouthful. So we have long-term debt, which is due over, let's say, 5 years. But of that, a part of it might be due in 1 year. So this is typical of a bank loan. If a bank loans you money for, say, 5 years, and they say $5 million, and they say, pay me $1 million a year for the next 5 years, well, how would you record that loan? Do you owe them the $5 million all more than a year from now? No. Do you owe all $5 million all within a year? No. Well, what is it then? Well, I owe $1 million in a year, and I owe the other $4 million in more than a year. Make sense? That's exactly how accounting works. If you have a 5-year loan that is payable equally over 5 years, you take the current portion of long-term debt, $1 million, and you show that as a current maturity, current liability. Non-current are, by definition, more than a year, right? So that's all they are. Typically, they're loans and mortgages, things of that sort, but they could be pension liabilities where you owe your employees money for if and not if, but when they retire. So it's well beyond 1 year. Owner's equity, we have the contributed capital, stock they bought and paid for, and then we have all the earnings that have occurred because the company is running at a profit. So earned capital is the beginning retained earnings plus net income minus dividends. So if we had Larry's Lemonade and you put in $100 for the stock in Larry's Lemonade, and I earned $50. If I keep all $50 in the company now has the use of $50. It's retained earnings. But if I made $50, I gave you, let's say we own 50% each. You put in $100, I made $50, I give you $25 in dividends, or I pay out $25 in dividends. Well, that means I didn't keep all 50 for my business, right? When we look at earned capital, it's retained earnings, and it's always net income minus dividends. And that's what we retained in the business. So examples, common stock is the most basic type of stock. That's why it's called common. And every company has common stock. Preferred stock is preferred, it's special, right? So not every company has to have preferred stock. So it's a different class of stock or different type of stock is preferred stock. The other thing you'll hear is additional paid-in capital. This we're going to cover a little bit more detail when we get to shareholders' equity. But it just is an accounting treatment on how do we record the issuance of stock. Treasury stock is when you buy back stock and you hold it for possible reissue in the future. That's called treasury stock. So I sold 1 million shares and I made so much money I want to buy back 1,000 shares. When I buy back, what is it, right? What did I just get? I got treasury stock. That's what that means. When you buy back your own stock, it's a negative item because it reduces the amount of outstanding shares. So it's a negative item in your shareholders' equity. Retained earnings, we've talked about several times now. Net income minus dividend. Accumulated other comprehensive income. This is a very technical item we'll cover later in the course, but it is a certain set of specified transactions that under GAAP you do not record them on the income statement. You record them directly into the equity statement. So again, for now, don't even worry about this one. We'll get to it when we get to it. Market value versus book. You've already seen from the land example that there is a difference between market and book. The same thing holds for equity. Just because somebody put $1,000 into Apple 20 years ago means it's worth $1,000. In fact, I have no idea what that $1,000 would be worth. So the market value of a share of stock is governed by the marketplace, by the stock market. The book value of what is paid for that stock, whenever you bought the stock, is what's on the balance sheet, is on the shareholders' equity. So again, a big divergence between market and book values, especially for very successful companies like Apple or Google or you name the success story. Okay, and why is it that way? Because GAAP requires things to be done with some degree of rigor and objectivity. And that's why we don't put in a lot of things that are market based and be whimsical or kind of fad based. We don't have any of that show up on the balance sheet.